Hello, everybody, and welcome to the Trader Newsroom. So this was the correction that we have been talking about. How low can we go? And will we see a relief rally heading into earnings season? My name is Michael DeJoy. I'm the Director of Educational Services here at Trader, joined by my co-host, Joe Malandrino, global markets reporter from Nasdaq and all around the world. So, Jill, um, we nailed this. I mean, we talked about the market being overvalued. We talked about uncertainty. We're now in correction territory, but what could potentially trigger a bounce, in your eyes?
Yeah, it's interesting, Mike. There was a couple of reasons why we thought that there would be, some reaction to the overvalue that we saw coming into the market. Yes, we know it's because of tariffs and policy. We don't know what that's going to look like yet. But even coming into this, there was so much exuberance from the election results to where we were through the inauguration, kind of got to that February 19th high. And, as the rhetoric heated up, the market reacted to it. But there's a couple schools of thought here that I think are interesting. No one is saying anything new because there's nothing to say, because who knows what the operating environment's going to look like, whether it's bonds, equities, digital assets, trade, whatever. But I had a guest on the show last week and he made a really good point. Trump 1.0, we didn't get the tariff talk until December 2018. And that's when you saw the volatility in the market. So he came into office, ripped the Band-Aid off. So we know at some point in the more near-term future that there will be a resolution, right?
Mm-hmm.
Rather than guessing when is the tariff talk going to heat up. I think where the surprise, and I thought that was interesting. I think it was an interesting way to look at it. So I think it's the velocity and the execution of it that are throwing people off.
Yeah.
And so there's a couple ways that you could think about this. If the market does rally, he looks like a winner. If he executes on what he promised during the campaign, he could say he did what he had campaigned on. So if you look at it in different ways, because there's kind of a head scratcher. Well, Trump 1.0 benched himself to the economy, to the market. What's the rationale now? So I'm curious to see how it plays out. I feel like, all right, let's get all of it out of the way now could potentially be a good thing. Or you can look at it, is this going to be what the environment looks like for the next 3.5 years? I'm trying to take it from, the silver lining side, because Mike, and with everything companies had to deal with in just that 5-year time frame, which literally a year since the markets, the economy shut down because of COVID, companies operated quite well from a corporate perspective. And I think, now may be the time to insert some volatility because the economy is still relatively strong. Companies are operating well. The fundamentals look good. It's probably better to do it now than it is in a crappy economy and just making a bad situation worse. So that's where I think we are. From a technical perspective, you're the chart expert. I don't know if it shows that there's a bottom in.
I think you touched upon a couple of points, and some things just automatically popped to my mind as you were speaking. Number one, I think the market rallied on Trump's victory based on Trump 1.0 being an incredibly bullish president who kind of gauged his performance to the performance of the stock market. But then when the reality of Trump 2.0 kind of set in, and he picked up the timing of the 2018 tariff trade war, it has been the tone of his entire Trump 2.0 100 first days. And I think that the markets are forward looking. They initially reacted before Trump was actually president, and the market rallied. And then we saw what he actually was going to do as president, which was Trump 2018 thereafter, and then the market has subsequently corrected, which makes perfect sense. It's very good analysis. You touched upon a couple of things, which was the Fed has mentioned that they potentially might do 2 more cuts before the end of the year. And again, another reversal from, the Donald Trump 1.0. He said that no action is needed from the Fed, in his opinion. And it sounds to me like, Trump 2.0 is much more free markets orientated. Your thoughts on this? Is this a free market, kind of let the market correct itself? or just because, like you said, the economy is fairly strong and fairly robust, it's better just to get it out of the way.
I'm hoping it's the latter. Um, I think if this is as bad as it's going to get, and it really isn't that bad when you think about it from where we were to where we are now. And Mike, we have such recency bias and no memory of exercising patience. And you're not going to make 25% like you did over the past couple of years every single year. There's a reason why it's called 7 to 8% return,
Absolutely. Yeah.
right? So there's that. You have a generation of traders and investors that have never seen prolonged volatility. COVID at the end of the day was a blip on the radar, but since a prolonged time of volatility, the financial crisis, what was that, 15, 16 years ago at this point, and we don't have near the level of liquidity that was in the market like it was during that time. So
Yes.
this is shocking for many reasons, because there was always a backstop there,
Hmm.
right? And in a way, it's remember they used to say with the Fed, there's a Fed put, it's like a morphine drip, right? Well, guess
Yeah.
what? The morphine drip went away.
Yeah.
So I'm hoping, okay, this is the time to do it, not when the economy's in the toilet like it was with the GFC and the market's
Hmm.
down 40-50%. Um, that would have been unrecoverable for a longer time. But
Hmm.
again, everyone was complaining there's no volatility. We have to turn off the morphine drip. We can't have the Fed put in there. Well, guess what? The morphine's
Yeah.
been taken away.
Yeah. And I have to agree with you that as a trader that is old enough to have seen markets in the past,
Yes.
this has been a zombie market, almost like kind of that reacts to every word or change in a word to the Fed. This is actually going back to freer markets that are not, on a morphine drip that is just
Yes.
constantly being fed quantitative easing money from the
Right.
Fed whenever it looks like it's shaking a little bit, which is natural for markets. So this is kind of, to me, I'm leaning in the direction that this is more about free markets and letting the market self-regulate versus this just being foolishness. And
Right.
from an economic, it's been a long time since I went to school for economics, but at the end of the day, this does seem to me like more free market, taking the market off of the morphine drip, as you put it.
Well, Mike,
Um,
can I make 2 points that we had called
Absolutely,
out?
and no doubt, I want to hear them.
So a couple of things here. And we've said this a number of times where it's almost like the business cycle wasn't allowed to happen. We weren't supposed to have a trough. We weren't supposed to have a recession. It was constantly being supported. The other thing is too, when we spoke, it was middle of February, it was somewhere around that February 19th time, and we
Hmm.
had this conversation where we pointed out we knew valuations were an issue. It felt frothy. It was, and I think like I said, the point of it's almost like investors are gamifying the dip. Buying the
Yeah.
dip became like a prop bet, right?
Yep.
Another indicator was, and we mentioned this as well, the divergence of performance with the European markets to the US markets, which was happening even before this correction that we see here, because that's where the value was. That's where, the multiples were down. So that trade was in place even before February 19th. So it
Yep.
was more of, okay, the risk to the upside is in Europe, right? And then, that got juiced once, the political environment changed, especially with European defense companies. So it's not like this is specific to the US and something that wasn't in motion.
Yes, I totally agree. Now your thoughts on the infamous transitory word. The Fed has dusted off transitory and brought back transitory. But is this time different? I know in the markets we're supposed to never say this time is different. But is this time the use of transitory as far as the Trump tariffs go? That the effect of the tariffs is a transitory or short-term effect. Um, I mean, it seems reasonable to me.
It does, it seems reasonable. We're not comparing apples to apples. So, for example, the GFC, that was something that was intransitory. That was something systemic that needed to be fixed. Um, we don't know what the execution and the final product is going to look like as it relates to the tariffs, and not understanding what your input costs are, if you're unsure if you want to hire or not, especially in services industries, because you don't know how that's going to impact your margins, which those margins are razor thin anyway.
Mm-hmm.
um it might be transitory to the Fed in terms of what the data looks like, but this is a transitory if you're the restaurant owner or the builder. So you have to think about it. It's almost like, Mike, we've said this a million times, this old saying. It's a recession if your neighbor gets fired, it's a depression if you get fired.
Yeah,
So
absolutely.
I think it depends on the context, and sometimes from the lens of the market and economists, you're in that bubble because the person who has to think about 20-25% input cost that has to get passed on to customers, and I can't afford to hire and build, that's not transitory to them.
Yeah. I mean, it seems reasonable, yet when I think about the shift in the economy, I mean, it's almost like we're rolling back the NAFTA 1992, like early 90s. I mean, this is a massive non-transitory shift in the way the United States interacts with the global economy.
Yeah,
So
well, I
I
also
don't
think there's
know
some
how
confusion
transitory
too.
that can be.
Well, there's also some confusion too because the Trump administration 1.0 negotiated the USMCA, right?
Hmm.
And that's being rolled back as well. So I think there's some confusion,
Hmm.
and it was unexpected. It kind of wasn't on the bingo card.
Yeah.
So, but again, I feel like if now's the time to do it where
Yeah.
things
Get the
are
pain out of the way.
right. And you have to remember, Mike, there is so much noise in the headlines. You peel that
Hmm.
back, the data, it's not growing, it's slowing, but it's not, you know,
Yeah.
blanking the bet.
Yeah.
So yeah.
Yep, absolutely. I like that. Um, this is and again at the same time, everybody is just looking at the markets, and technically, in a very big sense, it's long overdue profit taking. Now the question is whether or not there is going to be bigger economic ramifications, as the months and weeks go by, which could potentially be the big bottom portion of that iceberg. And then again, there is just a tremendous amount of uncertainty over what these tariffs are actually going to be, or is the negotiation bark worse than the
Mhm.
actual bite? So, any thoughts on the bark versus bite argument?
So going back to fundamentals, I think this is a really interesting stat, and we know, 9 of the S&P sectors are up. The two that are down, are consumer and tech related, right? But if you look at R&D spend, it is more this year than it ever has been, and R&D is what translates into future growth and earnings. And if you look at the Nasdaq 100 from a historical perspective, those constituents spend more on R&D than other indexes and their constituents, and look at the performance of that, right? So
Hmm.
the fact that they're deploying cash, which are on healthy balance sheets, and thinking about how that growth is going to translate, that makes me more comfortable. If they were
Yeah,
afraid to deploy towards R&D spend, I'd be a little bit nervous.
that's healthy economy activity. When you're investing in the future to do research and development, that is not depression or recession kind of activity. So I would definitely agree with you there that that is a positive indicator. So I'm actually, I'm going to the Islanders game tonight, and they're
Nice.
playing the Canadians. So I'll see if there's any drama there. But I want to wish you a wonderful weekend, and I'll see you in 2 weeks. Thank you so
Oh,
much, Jill, as always.
see ya. Take care,
Bye bye
Mike.
now. All right, let's jump to the charts and see where we go from here. So we're just going to, jump to do some market analysis as we always do. All right, so here we have my dash trader. I'm just going to expand this out. The first chart that I'd like to look at today is gold, and then we're going to do some level analysis on DAS, looking at the S&P, the Nasdaq, and then of course the Magnificent Seven. So GLD, which is the ETF that is the tracking ETF for gold. Jill and I had been talking about gold pretty much since the pandemic. But certainly in the last year, you can see that gold is pressing the very, very top of the chart. SLV also rocking at the top of its range. That's silver, which, silver usually outperforms gold in bull markets and underperforms gold in bear markets, but certainly silver and gold near the top of their charts, respectively. But also, gold is breaking out to new highs over $3,000 an ounce, which is an all-time high. And, let's take a look at QQQ. So the QQQ making a equal-sized pullback to the last correction that we had at the end of, actually in the middle of 2024. So I'm just going to use this trend line and just to show you how we measure the pullback. So I'm going to just measure it from here, from the peak to the trough. And I'm just going to drag this. And I mean, this would indicate that we got a little bit more downside, but that potentially we're near a level that we might expect some kind of a bounce in the near future. And again, this uncertainty has a lot to do with the tariffs that really go fully into effect on April 2nd. But I think that a lot of that bad medicine has already been taken. You could also see that you have a lot of congestion on your charts here to the left. Okay, so you got a lot of congestion on the charts here to the left. And that's pretty much the level that we've pulled into. So we've come off the double top of the highs. We've made a double top and we've made our drop. We're probably going to get a little bit of a bounce at some point. If we don't get a bounce, then we would make another measured move down. And just to show you how we do the measured move analysis, just going to do that. So I take this measure of this move and I would project it down to the bottom. So it would be up a little bit higher. So it would be a measured move down, right? Which would take us to about the 420 level on the QQQ, 420 or so, which is around the bottom of the prior sell-off. If we made another sell-off, that's where it would take us on the N-shaped pattern. It's a little bit of a skewed end, but needless to say, that would be the level that you'd expect. If you bounced, your bounce would probably be, I'm just going to grab my Fibonacci tool. Fibonacci line. Just going to start it from here. So your bounce would probably be to 50%. That would be a bearish bounce. If you went to a more bullish level, then that would be around 510. So 500 or 510. 500, anything less than 500 would be bearish. Anything more than 500 would be bullish. So let's just take this and just reverse that. There you go. So any bounce up to 510, that would be a bullish bounce, right? Anything less than 495 would be extremely bearish. Right now, we are at 23.6, which unless we bounce soon, this is a very, very bearish retracement, meaning that you'd expect more downside to follow based on retracement analysis. All right, let's take a look at the SPY. That's the spiders. That's the more the more broad index. So the broader index, the SPY, and I'm just going to show you the same measured move analysis. So this lines up, right, with that 570, which is the current high. And that would take you right back down to the 510 low on a secondary sell-off. So the S&P lines up even better than the Nasdaq. However, we do know that the Nasdaq is the leading indicator. The Nasdaq is what led the markets up. The Nasdaq is what has surged up. With Nvidia and the AI kind of boom. So certainly the Nasdaq has been the leader. The Dow DIA looking a little bit more bearish. But at the same time, a measured move down on the Dow would also take us to 386, 384 lineup back to support, which would be awesome. And then again, that would technically be a bearish lineup. Now, if we do bounce, yeah, I'd probably expect to bounce up to 430 on the DIA, which is the ETF for the Dow Jones Industrial Average. Next, you got NVDA. That's NVIDIA. NVIDIA has been sliding, but the stop and the slowdown has slowed. So if you look at NVIDIA, NVIDIA is saying that the market is getting ready for a bounce. TSLA, Tesla, number two, the big seven, big seven. I mean, Tesla looks higher. This stock has been utterly beaten up. It's like, it definitely looks like a parabola or a bubble. But again, it is no longer going down. So when markets fail to move down, they are most likely going to move up. MSFT, okay, MSFT, also looking like it's getting ready to bounce. AAPL. So based on the component stocks, Apple looking bad, but based on the component stocks, I would say that the market is more than likely, the odds are leaning towards a bounce, a directional bounce to the upside. Now the question is always, how far do we bounce? Right now we're at 23.6. The next level would be that 38% retracement level. 38, then goes 50, then from 50 to 62.8. So those are those key numbers. And again, I got Apple, we got NFLX, right? Netflix, gap faded and filled as you would expect from the big earnings gap up, and then it's already been bouncing quite a bit. So Netflix is stronger than the market overall, and that is a good sign for a bounce as well, that Netflix is leading the market kind of out of it. All right, so I'm going to jump back and wrap things up. Just want to say that it has been great to go through the charts and to be vindicated as far as, hold on a second, stop sharing. Let me just try this again. Share. Vindicated that we were able to, Jill and I were able to kind of identify and spot the market correction accurately, and of course call the bull market in gold, which we did very well. So stay up to date with all things DAS by signing up to our monthly newsletter and emails. Fill out the form at the bottom of our webpage at www.dastrader.com. Subscribe to our YouTube channel, Dash Trader TV, and follow us on social media, LinkedIn, Twitter, Facebook, and Instagram. Wonderful to be with you as always. Trade well, everybody. Until next time.